Diving into our introduction here for our consolidated returns, we're going to talk about them. We're going to talk about the pros and cons of doing a consolidated return. What is it? Why you would do one? What you need to do in order to do a consolidated return. First off, we're going to see that it's a method used by an affiliated group of corporations in order to combine their tax liabilities and file a single tax return rather than filing separate returns for each entity. There are going to be many instances, and it doesn't have to be a 100% owned subsidiary, but for the purposes of visualization right now, because everyone's a nice visual learner, right? Think about it. If we've got McDonald's USA, and then they own 100% of McDonald's France, McDonald's England, McDonald's Brazil, McDonald's Japan. So those are all affiliated entities. Again, it doesn't have to be 100% owned, but just for the purposes of visualization here, think about it like we've got fully owned subsidiaries. Now you can choose, are you going to file tax returns individually for each group, or are we going to do a one solid consolidated return? Even more concise and a better example maybe would be to break it up among U.S. states because we're dealing with U.S. taxation. Not even to worry about different countries' taxation, but if you were to deal with McDonald's New York, McDonald's California, McDonald's Texas, etc., that would be another way to do it. I'm not sure if that's how McDonald's has it broken up, but just think of that as an example. So we're here to be visual. We're here to understand what's going on. Now, this method allows corporations within the group to offset gains and losses against each other, potentially reducing their overall tax burden. That is a super promising idea. Think about individuals. Now, obviously, individuals do not have this advantage unless you're married. But let's say one person has significant losses, significant investment losses, significant medical expenses, but they don't have a lot of income. And another person has a lot of income, but they don't have a lot of deductions. Well, ideally, it would be great if those people could both combine their returns, taking the benefit of the deductions from one person to offset the income from another. Now, they can't really do that because they're individuals. And again, unless they're married, that's a whole nother topic, dealing with individual income tax. But corporations can do that. If they are related, if they're affiliated, we'll talk about what that means as well. So again, just kind of trying to paint a picture here so you understand what we're dealing with. Now, to be eligible for filing a consolidated return, an affiliated group must consist of a parent corporation and one or more subsidiaries connected through stock ownership. That's what an affiliated group is going to be, super broad in general. Let's keep diving in and see more.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.Examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.